Today I'm going to show you a range fade scalp. It's a strategy that works well in choppy or ranging markets, generally when the market isn't moving directionally. So it's a good strategy for the summertime when we do have a lot of chop and volatility kind of dies out. Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results. So you can see on the footprint chart that we've been chopping in this range for a little while now. And every time we get down near 59 even, we have buyers that are absorbing selling, and anytime we get up above 60 half, we have guys on the offer that are absorbing all of the buying. So what I like to do is just mark off this range, make a mental note of it, and then put in a limit order in the dome. I like it to be, you can see how it's kind of at a volume ledge at 59 even, that 5,770 contracts. I like to see that. And what happens is I'm gonna get filled here, and if it starts to go against me, if it goes just a tick or two against me, I'm okay with that. But what I want to see is if they're selling, there's guys on the bid that are absorbing that selling, or buyers come in aggressively. The ideal case is, of course, you get filled and then it just goes immediately in your direction. And I'm just looking to get a few ticks out of this. I typically look for kind of the midpoint of that range, and I take my exit. I typically only do this scalp on one side of the range, and I do it long if I think it's most likely that we're going to have a breakout long, and I go short if I think it's most likely that we're going to have a breakout short. And that's just because I don't want to get caught offside if this thing does start to run against me.